Hello, everyone. Welcome back to the Financial Shepherd Happy Hour. My name is Joshua Casey Garland, certified financial planner, owner of Shepherd Wealth Management. I have my good friend and video editing genius, Ezra Kellerman, here with us today.
Yeah.
Obviously, it's a suns out, guns out type of Friday, so we're feeling pretty good here. It was a great day for the market, and the reason why we do these little happy hours is just kind of really short and sweet, 10, 15 minutes, summarizing the week that happened. Why did it happen, and what can we look forward to in the coming weeks ahead of us here, since we're right in the middle of earnings season for Q2. CEOs, CFOs are giving guidance for Q3 throughout the rest of the year. And it was a very busy week with a lot more to come. So the headline news at the beginning of the week was the CPI inflation data coming in at 9.1%, which was even hotter than the prior month, which came in at 8.6%, which again was way above what economists were hoping for, certainly something that the Fed was hoping to not see. However, today was a little bit of relief. We saw a relief rally today, pretty much everything across the board for the NASDAQ, Dow Jones, as well as the S&P 500. Almost all sectors were in the positive. The only laggards being utilities and staples in the S&P 500. It was a really good day for stocks individually. Mostly has to do with the fact of the retail sales numbers that we got today, this morning. They were up 1% since the month of June. Economists were expecting maybe 0.9%. So it was kind of one of those Goldilocks numbers, wasn't too hot, wasn't too cold. So he had a nice little rally today. The reason why we had the rally is because I think a lot of analysts and economists were calling for the Fed to raise rates even more aggressively than what they had been. Right now, or prior to the inflation data that we got earlier in the week, everybody was expecting a guaranteed lock of a 0.75% increase in the overnight Fed funds rate. When we got that core CPI data on inflation coming in at 9.1%, everybody kind of thought that they would go from 0.75 to a full 1% increase in rates. And that caused a big sell-off for the market for the week. And then today, because of the retail sales news that we got, again, coming in kind of Goldilocks, not too hot, not too cold, the market had a nice little rally. However, with all that being said, all that really means to the stock market, analysts and economists, is everybody's trying to peg whether or not the Fed's going to increase rates in July. I believe the 27th of July, they'll make that announcement, whether or not they're going to stick with 75 or jump up to one full basis point, 1% increase in that overnight rate. And because of the retail sales coming in, again, not too hot, not too cold, I think the market rallied simply because they were now anticipating the Fed will stick with that 0.75% Fed funds rate increase. And I think the reason for that is the Fed chairman, Jerome Powell, and his colleagues, they're all looking at all this data all the time, of course, even have a lot more information than what we would have as individual consumers here in the economy. And I don't believe that they're probably going to jump to that full 1% rate, even though inflation came in a little bit hotter. Retail sales numbers not coming in too hot or cold would say that consumers are willing to pay for things, even though it's costing them more money. They may just shift the way that they're spending some of those dollars to kind of get through this high inflation that will not stick around forever because of the actions that corporate America and Federal Reserves around the world are taking here and raising rates. So could be some light at the end of the tunnel. But the rally today had everything to do with the retail sales numbers that we have. Nothing else has really changed. It's just a question of whether or not the Fed's going to stick with 75 basis points or actually go up to 1%. However, even though today was a really good day, the whole week was pretty much either flat or in the negative for the major averages. S&P 500 was down about 0.6% for the week. NASDAQ down about 0.75% for the week. Dow Jones nearly flat, slightly negative. Russell 2000, which is your small cap index, that was down 1.4% for the week. And the Wilshire 5000, which is kind of like your catch-all index for the U.S. stock market, that was pretty much flat for the week. So not a terrible week, but certainly not a positive week in general for the overall averages. We just had a nice little rally today, thanks to the data that we got from retail sales. Now we have had some earnings come out this week as well, which caused a little bit of volatility. JP Morgan, Jamie Dimons, their CEO, they did not meet analyst expectations for revenue or their earnings per share. They missed by a decent margin, which isn't great, obviously. But his reasoning for that is they're worried about potential loan losses. So they took a bunch of capital that they would otherwise potentially be able to invest is set it aside because they're trying to prepare themselves for all outcomes, is what Jamie Dimon basically said. It's like, we're going to be good and a thriving company, profitable and growing, even though we might slow hiring, even though we might have a slowdown in our earnings and revenue for a short span of time here while we're kind of getting through this. But he's preparing for the potential worst case outcome. And of course, if that doesn't happen, then JP Morgan and their shareholders will certainly be in a position to make a very quick pivot, assuming that we don't actually have, the worst case scenario actually playing out. So JP Morgan missed. Citibank actually dominated their earnings call. The stock was way up today. I saw it was up about 14%. United Health Group also beat revenue and earnings per share expectations. Stock's been great all year for all shareholders. I know that we're a shareholder here at Shepherd Wealth Management. Yeah. And it's kind of one of those positions where it's a good place to be in a volatile environment, and when recessions happen, people are still going to make their insurance premium payments.
Right. We talk about that, reallocating your spending. That's one thing you really can't afford to not spend money on.
For sure. So it's been a great position to be in all year long. They had a great quarter. I expect more of the same to come for them as well. And lastly, we have some pretty interesting data. Obviously, I do a lot of research for my clients and to kind of prepare for these live YouTube videos that we're doing. And by the way, if you have questions, you can either post them right in the live stream on the channel here, or you can simply just text us 513-630-2664. So I got to give one of my all-time favorite money managers, authors, CNBC contributor. His name is Josh Brown. He's been on CNBC for a long time. I read all the books that he wrote. I'm a big fan of what he does. He's the CEO and co-founder of Ritholtz Wealth Management. And he had a very nice article that he wrote here. And I'm going to take that information and share it with you all today. So the S&P 500 has had 33 consecutive weeks of more stocks making new lows than making new highs. We haven't seen anything that bad since the great financial crisis of 2008 and 2009. With that being said, however, what we were able to also see from his report and analysis that he did, he went back through all 12 of the bear markets that we've had since World War II. So this is going back to November of 1948. The one exception that we had was 2008 and 2009 was obviously a pretty significant pullback. A lot of people felt like it was very much a bloodbath sort of environment. And it certainly was, with some of the largest financial institutions, going out of business. And it was definitely a dark day for the U.S. economy. And right now, with 33 consecutive weeks of more companies in the S&P making more lows than new highs, again, it's very, very similar, not quite as bad as what we saw in 2008. Now, is this scenario that we're going through in 2002 as bad as 2008? In my opinion, no. A lot of this has to do with things that are just simply not controllable by the Federal Reserve, things like supply chain problems, and certainly a war going on over in Europe. It's certainly something that nobody has any control over. However, in this article piece, if we go out 1 year from virtually every bear market that we've had going back to World War II, 1 year later was significant outperformance, with one exception, that being the tech bubble of 2001. Starting in March through November of 2002. Other than that, we've had significant performance. You go to 2008, again, as being a comparison to the 33 consecutive negative weeks we've seen in S&P 500 companies making new lows compared to new highs. Well, 2008, if you go out 3 years later, you have some pretty significant performance. In 5 years, you're looking at over 35%. But I actually am interested in that 1981 to 82 era, which was the only other time we've had inflation worse than what we have right now, right? We were youngsters. Well, you were a youngster. I wasn't even born yet.
Yeah, I was just born.
Yeah, and you weren't taking out a mortgage, but home mortgage is like 20%, right around 81, 82, something like that.
Yeah.
But that was the only other time in U.S. stock market history we've had inflation as bad as what we have right now. And it was certainly a lot worse in 80, 81, and 82. But that bear market that happened in July of 1981, 6 months prior to that happening, the market was down 1%. During the actual recession, though, the market was almost up 15%. And if you go out 5 years later, the market's up over 100%. So yes, we're going through some very painful times right now. It's not fun to watch, seeing all these positions of great companies, simply just getting beaten down due to the overall sentiment that investors have. By the way, the University of Michigan came out with their investor sentiment survey again. It was only slightly better than the prior month. Last month in June was like the lowest reading in the history of, since they were taking the survey.
Yeah, we had that on one of the last happy hours we did. We were lamenting the low numbers.
Yeah, we were.
50,
and
right?
It came in at 50. Well, this month it came in at 51. So it's just a notch better.
But you're telling me it's getting better.
It is. And I say all that, with a little bit of a chuckle, because honestly, when you look at some of the greatest investor of all time through our lifetimes, for sure, Warren Buffett, I don't think that's disputable. If he's not the best, he's certainly in the top, 3 for sure. He spent over $50 billion on either new stock positions that he didn't own or added to positions that he already had. And the biggest one lately was Occidental Petroleum. He owns almost 19% of the company. And by the way, he could buy the whole company because he still has $100 billion sitting in cash. It would probably take about another $75 billion to buy them outright. But anyway, he's putting actions behind the words that he's been preaching for 57 years. I ran an analysis today. Since Warren Buffett took over Berkshire Hathaway, Charlie Munger in 1965, all the way through today, their average annualized return for Berkshire shareholders was over 20%. That's 2 times better than what the S&P 500 has done. That's 57 years, right, of consistency. Now, he hasn't always beat the market every single year. And if you look at the purchases that he's made the first 6 months of 2022, his timing has been terrible. All of the positions are essentially down. However, the guy's in his 90s and he's making decisions for his shareholders looking out 5, 10 plus years. He doesn't care what happens this year or next year. He's looking at the long term.
Yeah.
And what he always said was price is what you pay and value is what you're going to get. So the man is literally putting action behind the words he's been preaching for nearly 60 years. And he's done it better than certainly everybody that's watching this and pretty much everybody that I've ever had the privilege of doing research and studying on. But he's making acquisitions, knowing that when everybody else is pessimistic, he wants to be very greedy. So I'm not saying that we found a bottom yet. History would say we're probably not quite there yet. The average bear market pullback in the S&P is around 31%. I think we're down about 22% right now, roughly. And the average number of days in a bear market is about 280-ish days. So if history were to repeat itself, and the other thing that Buffett said about human beings is they don't learn from history.
Learn from past.
So he's doing things where everybody else is seemingly selling things. But if we were to go out 280-ish days, that would put us right around October, which means we could see the market pull back a little bit more if history does in fact repeat itself. And these are averages. So again, bottom could happen later, way past October. We may have already seen a bottom. We don't really know. We won't know until we have perfect hindsight and say, oh yeah, that was the event that caused the bottom and here was the actual recovery of that. But simply put, he's anticipating the inevitable recovery that the market's always had. So you go 26 bear markets, there's been 27 bull markets, and the bull market has lasted a heck of a lot longer than bear markets. So he's positioning himself to benefit from that recovery. And that's exactly what we're trying to do for clients here at Shepherd Wealth Management. We've been doing quarterly reviews. We've talked about rebalancing sometime between now and October when we'll have another quarterly review. And we're not going to rebalance everything in one shot. It still will give us wiggle room if we haven't actually seen a bottom and the volatility slowing down some for the markets. And we'll simply be able to continue to do that because we have exposure to some asset classes that actually have done well this year, like healthcare, like defensive companies. I don't mean like defensive like utilities. I mean like companies that make guns and bombs, like a Lockheed Martin has done very well. And certainly the energy space has been the only sector of the S&P 500 that's been positive so far in 2022, which we can certainly rebalance from there as well. So these are things that have happened in the market. We have some indication as to why the market has responded the way that it has so far this week, as well as overall this year. And we've talked about some things that certainly will put you in the right direction to minimize the volatility that we're going through right now and put yourself in a position, just like Mr. Warren Buffett, to benefit from the inevitable recovery. We don't know when it'll happen, but it's always happened every single time that we've had a bear market. So unless you're counting on the end of the world, just like we've always said is, you can't bet on the end of the world.
Because who are you going to collect from?
Who would
anyway?
you collect from? Exactly. So
last thing you're worried about is your stocks. If that's what happens.
That's exactly right. So this has been a pleasure. we were able to enjoy this happy hour. I hope you all have a great weekend. Please join us again next Friday on the Financial Shepherd Happy Hour right here on YouTube. Again, text your questions or simply drop them in the live chat here. I'm Joshua Casey Garland. This is my great friend and video editing genius, Ezra. We welcome you to come back to the show. We'll do this every Friday, and I certainly hope you all have a great weekend, and I look forward to doing this again next week. Cheers.